Okay, it's noon, so we can get started. Hello, everyone, and thank you for joining us today. My name is Kelsey Lefebvre. Welcome to the Connecticut Investment Tax Credit webinar. Before we get started, I'd like to offer a few technology tips to keep in mind while you're viewing today's webinar. First, all attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be time for questions and answers at the end of the presentation. Questions can be text chatted in at any point during the presentation. To send in your question, click on the question mark box on the right side of your screen to expand a question box where you can then type in your question. And then lastly, a recording of today's webinar and presentation materials will be available at farmcrediteast.com.
Thank you very much.
Oh, sorry, Chris.
Kelsey. Continue.
Just a quick disclaimer, this information is presented in good faith and not intended for investment, tax, or legal advice. Now I'll hand it over to Chris.
Thank you very much, Kelsey. We're excited about today's webinar. I'd like to begin by introducing Paul Larson of the Connecticut Farm Bureau. This webinar is co-sponsored by Farm Credit East and the Connecticut Farm Bureau. CFB was instrumental in getting this investment tax credit through the Connecticut legislature with their support. So I'll let Paul, who is president of Connecticut Farm Bureau, take it away and say a few minutes on behalf of CFB.
All right, well, thank you, Chris, and thank you for that introduction. As Chris said, my name is Paul Larson. I'm the current president of the Connecticut Farm Bureau Association. My wife and I live in Woodstock, where we have our greenhouse and nursery business, thanks in part to the support of Farm Credit over many years. But first, let me say that I'm very pleased that the folks at Farm Credit East have organized this presentation on the new Connecticut Farm Investment Tax Credit. I fully believe this new law for Connecticut farmers will be a huge benefit for many of us in the ag community by providing significant financial incentives for expanding, diversifying, or simply upgrading the buildings and equipment on our farms. While it took many voices working together in collaboration to get this tax credit program passed in the recent legislative session, I truly believe that it would not have happened without the leadership role of Connecticut Farm Bureau. I realize that many of you on this webinar are likely members of Farm Bureau, and I want to say thank you for your support of our organization. You recognize the value of working together to achieve great outcomes for all of agriculture. To those of you participating today who either have never been a member of Connecticut Farm Bureau or perhaps were a member at one time but are not currently part of our organization, I strongly encourage you to go to our website at cfba.org and become a member this week, and just do it. The savings that one farm can realize through this new tax credit program on a new building, a new piece of equipment, whatever you're doing, will easily pay for your membership for many years to come. If there's one thing I've learned since I started working on advocacy with Farm Bureau, it's that in order to get a significant item, a significant piece of legislation like this accomplished, we all need to be in the same boat with all of us rowing in the same direction. So it's important that we have a broad base of farmer members in our organization. If you have any questions or need any information on Farm Bureau, please reach out to me or our Executive Director, Tracy McDougall. Together, we can accomplish much, and we've got a busy legislative session just around the corner. Again, I want to say thank you to Farm Credit East for helping us all learn how we can benefit from this tax credit in 2026 and hopefully for many years to come. So thank you, Chris. I'll turn it back over to you.
Thanks a lot, Paul. And what is the website if people want to get more information on CFB or to join?
It's just cfba.org.
Excellent. So our main presenter today is Dario Arezzo. Dario Arezzo is the Chief Financial Services Officer here at Farm Credit East. He's also a former Cornell football star as well, to the extent that that's such a thing that exists. I always have to give him a ribbing on that. And he knows why. But Dario, I'd like you to take it away and enlighten us about the investment tax credit.
Happy to do so, Chris. And just to confirm, can you guys see my screen?
Yes.
Yes, we see it now. Yep.
Yeah, I appreciate it. Just but before I do, as Chris mentioned, my name is Dario Arezzo. I'm the Chief Financial Services Officer here, who oversees our tax, accounting, consulting professionals across the Northeast. And I'm really excited to present this topic to you today. As Paul had mentioned, really we appreciate the value that Farm Bureau has brought, on this issue in Connecticut. Farm Credit East worked closely with some of our producers as well as Farm Bureau, really after decades in New York State on a similar program. So when the ask came to Farm Credit East of how to help present some of this language and tailor it from a tax perspective, we were certainly happy to provide any assistance that we can to Connecticut farmers. And I couldn't echo Paul's comments more on this is a big deal for Connecticut. It's a tremendous win. Took a lot of effort, and farmers in the state are going to benefit from years to come. So just a sincere thanks to Paul, Tracy, and Farm Bureau members across Connecticut who have helped push this through, as well as our own members as well. So with that, what I plan to do is spend the next roughly half an hour or so giving an overview of how this credit works, and then leave ample time for Q&A, questions and answers, since I know there's probably a lot out there. It's brand new to Connecticut, and I'm sure folks have a lot of things on their mind. And as Kelsey mentioned, text chat them in. Yeah, we will get to as many as we can, and if we can't get to them, we will follow up in an email back to you with those questions. So at a very high level, what is this? The new investment tax credit, it's 20% refundable. So in other words, it's not like a typical credit that maybe offsets your tax and then it carries forward or goes away. This credit puts money back into your pocket to the extent that it first will reduce any Connecticut tax you may have, and if there's excess left over, it'll come back to you. And we'll go over some examples of that. But just think, at a high level, if you have a $50,000 refundable credit this generates, and your state tax is a couple $1,000, you'll get back the difference of $48,000. This is going to begin January 1st here. It's effective 1/1/26 for taxable years that commence on or after that date. As I mentioned with New York State, this is very similar. The legislation is very similar in that regard, and Farm Credit East has had a lot of experience for a lot of years with New York's ITC, understands the mechanics of it, and that model legislation helped mirror what is now in place, by and large, for the most part, in Connecticut's. And what we've seen in New York State is that it really has helped farmers with CapEx, buying that next piece of equipment, machinery, putting up that next expansion of a building. It has significantly boosted farmers' ability to do that in New York State. We're seeing great success here in the state, and I anticipate and hope that Connecticut will bear the same fruit as word gets out here through Farm Bureau, through Farm Credit East, on how all of Connecticut agriculture can begin to think about this and get proactive in their planning for 1/1/26. And really that planning will begin, in my opinion, now in Q4, thinking about the upcoming tax change. So an example here with Farmer John, if we'll get into eligibility, he has to be an eligible farmer. He has to buy eligible equipment. Let's assume that is a true fact for right now. If he buys $500,000 of equipment in 2026, there'll be a 20% ITC, investment tax credit, on that equipment purchase. That's $100,000 refundable back to Farmer John in this example. If he owes a few grand of Connecticut tax, in my example here, $5,000, he'll get back $95,000. That is significant. And you can, as you're watching this, depending on the size and scope of your business, no matter what size or scope, it's going to impact you in a pretty significant way. So we need to be thinking about this now, thinking about CapEx now, and thinking about what this means for future cash flows of our business as we get into strategic planning of what we have in store for 26, 27, and beyond for Connecticut farmers. One of the first criteria to qualify is that you have to be, what's called a quote unquote eligible farmer. Essentially, that's deriving 2/3 of your gross income from farming, from federal gross income from farming. So in other words, think of it if you have a Schedule F, for example. I'll show you an example in a moment there, but your typical farm income, it's a 2/3 test. And maybe your entity, you have a partnership that's got stuff, is that 2/3? Is your individual sole proprietorship, is it 2/3 from farming? Because that's where things can get tricky, is that's the first bar of, okay, if I have a bunch of other income going on and I also am raising some crops, am I meeting that test to begin with as a gatekeeper? In the rules, they do allow, like New York, as I mentioned, sort of a 3-year average rule where you can look at the current year and the previous 2 consecutive preceding years to see if you can get to that 2/3 test. And that 2/3 test does have what I like to call a $30,000 cushion. So in other words, the statute allows you to reduce some of your de minimis income as it relates to the farm to see if you qualify for being an eligible farmer. So like, for example, if you had a $30,000 W-2 and $100,000 of Schedule F farm, the W-2 would kind of go away for the purpose of figuring out that ratio because you got that 30 grand cushion. So that's what that looks like there. Again, I expect more explanation to come out on that cushion piece of it, but giving my experience in New York State and how it works, that's typically how it's going to work here in Connecticut as well, because there's that little buffer of, we know farmers have maybe some other income coming in to support the farm or other things there, and that little buffer's there to not have anybody get thrown out of being a qualified farmer inadvertently. So again, in an example here, you can see maybe someone's got 80 grand W-2, some farm interest or some interest dividends that are not farm income. You can see my calculation there. Okay, 95 grand of non-farm income stuff going on in the return. We get a $30,000 cushion. So that's 65,000 bucks of non-farm income. Maybe we have 100 grand Schedule F. You got to kind of figure out the math, or your preparer's got to figure out the math for you and determine if you are at that 2/3 level or not. And that's going to make a big difference. In this case with my math there, if you got 95,000 of non-farm income minus that $30,000 cushion, leaves you $65,000. When you kind of add it all up with your farm income of 100 grand to get to 165 of total income, you're not quite at that ratio. So being aware of that, if you're on the margins of supporting the farm with some non-farm income, is important. Don't just assume you automatically qualify, because you may in fact not qualify. It's all in the keyword eligible, not just farmer. Entities can qualify. So, right, if you have a multi-member partnership as a Connecticut farmer, if you have an S corporation, the new law allows those shareholders and partners to claim their pro rata share of the tax credit. So if Chris Lawton and I, for example, were 50-50 members of the Connecticut Farm Credit Farm S Corp, and that entity had $100,000 of the ITC, Chris and I would share that $50,000 a piece, because we would get our pro rata share of that amount. In a similar vein, if me, Chris, Paul, and Tracy were all 4 members of a partnership at 25% a piece for our profit sharing, and we got $100,000 ITC in that business, we would each claim our respective $25,000 at our individual level as it kind of flows through down to us from the partnership. So in other words, the entities will be filing the paperwork on their tax returns to claim the credit, and then the partners and or shareholders will claim their respective and get their respective pro rata shares that they're entitled to. So what one's percentages in an entity will determine ultimately what they get as part of that entity's ITC for things that the entity does as far as building buildings or machinery and that type of stuff. And here's just an example illustrating what I just showed you there, as far as if you have an LLC and in this case, it's 50-50. That LLC's got $100,000 of ITC that it generated, right? So it bought a $500,000 or built a $500,000 facility that qualified. The members would get that 20% of that $500,000, 50 grand a piece. So that's how that would work. In this case, I had a partnership LLC here in Connecticut. Step one, you got to be an eligible farmer. Like I said, 2/3 gross farm income. Then you have to determine if you have bought an eligible farm investment property. So you have to buy and or acquire, construct machinery, equipment, buildings. They have to be in Connecticut. As I mentioned, this thing starts January 2026. There are some rules around the holding periods. You can't buy it with intent to lease it or lease the property. There's some timing durations there. Like New York State, there's also a 5-year holding period where if a farmer does not hold the asset for the full 5-year period, there is some recapture back. So in other words, if you got a credit back on your tax return, you'll have to pay some of that back to the state with some additional interest factor in some cases as well there. And you also have to use, the equipment in agricultural production. So things like you're seeing on the screen here: crops, dairy, forestry, wine production, Christmas trees, oysters, clams. So this is all defined in the law from the Ag Code in Connecticut, as well as the Bill 1497 added a few other things like the wine production, the Christmas trees, and the apple juice and cider stuff. That was all part of the Farm Bill 1497 there. And the other items there are from in statute reference to section 12-412. So it's basically the code of the statute that deals with some of the farm stuff in Connecticut is where they're pulling the definitions of what it means to be used in agricultural production vis-a-vis what type of endeavors fall under that amount. I mentioned the recapture provisions already, but I want to spend a moment here noting that, again, like New York, there are related party prohibitions on claiming an investment tax credit. For example, if you buy something from an entity of which you wholly own. So think of stuff like that. If you are buying from a related party as they define it there, which kind of common control over entities, there are attribution rules, which means that they look at things kind of holistically to determine that. So the point there is just, again, I don't want to belabor that's one of those nitty-gritty tax parts of the code that are for your accountant and your professional to deal with. But there are some preclusions of, you can't just game the system and buy things from an entity that you own and kind of churn around and get ITC, sell it back. So by and large, if you are buying assets from dealers or people that aren't related to you, not going to be an issue, but just worth mentioning here at this point as don't assume all purchases qualify, particularly if there's a connection to an entity of which you or certain relatives are a part of those common control. I'll just have that in the back of your head and make sure that your professional understands the rules around that. But the one thing I'll mention on the recapture provisions there is that depending on how long you hold it, if you don't hold it within the 3 years, you got to pay back the entire amount. If you hold it 4 years, it's a little bit less, 5 years. But there's pretty steep haircuts for not holding the property for the full 5-year period. But depending on how it plays out, it may or may not make a big deal. For example, New York's got a similar rule as far as a recapture. And oftentimes, as farmers are kind of disposing of equipment, they're buying new equipment. So as the equipment kind of turns over, the new ITC that you're getting on the new equipment tends to offset any recapture usually, and it ends up not being a big deal. But it is important to just keep in mind that the intent is to boost, right, farmers buying building CapEx in Connecticut. And so the goal is to be doing those things and holding those things for a 5-year period. And if there's not, that's okay, but be aware that there are recapture provisions that your preparer will have to deal with on the return. Again, New York State, it happens all the time, not a big deal, just something that people need to be aware of as far as how that works. As we look into the end of the year here in 2025, looking at setting ourselves up for success in Connecticut in 2026, got to begin to think about, in my opinion, that the planning for that starts now. Thinking about as you go into 26, excuse me, the economics probably between, for example, the purchase of a piece of equipment versus the lease of equipment, those dynamics have probably changed, right, in favor of purchases when you think about the 20% ITC versus maybe a farmer would have historically leased a piece of equipment for various reasons, right? Cash flow, and that may still be a consideration for cash flow. But by and large, the math on getting back 20% on CapEx now, in my experience in dealing with this issue in New York State, a lot of folks have geared more towards the purchase of equipment compared to leasing, again, unless there was some cash flow needs that overtook as the main priority there. But it's really tilted the playing field, in my view, to purchase versus a lease. So I expect that trend will probably play out similarly in Connecticut. But it's things like that I would encourage farmers and their advisors to begin thinking about now as far as setting up what their CapEx plans look like in the future. And even as you get into tax planning here, which farmers should begin tax planning now if they haven't already with their tax advisors. I know a lot of our folks here that work in our Connecticut offices have started talking to some of their customers already about considerations for tax planning. But even there, it's maybe thinking strategically, perhaps that equipment that you were going to buy in December, maybe that equipment is better bought in January, for instance, because that 1 month difference could alter and will alter whether or not you get back 20% on that equipment purchase. So maybe there's a better way to tax plan in Q4 with additional prepaids or inputs and kick off some of that CapEx into January and Q1, so you can really optimize and take advantage of this new legislation for when it comes into effect, which is January 1st, 2026. Couple lessons learned, or maybe again, hopefully it's better in Connecticut. Not that it's bad in New York, as far as I'm about to say is, but typically the first year that this came up in New York, we still have it now. We're in year 3 of this refundable 20% credit in New York. We started in 2023. The state, and for good cause, they're doing their jobs, but they may audit pretty decently on the issue, which again, they're making sure people qualify, that they're farmers. There's a lot of money going out the door. So my recommendation to farmers is to make sure that you just kind of have really good sound record keeping, keep your invoices, have everything nice and tidied up so that your ducks are in a row, so that if and when you do get a letter from the state that holds up your refund, you can respond to those things promptly. Lessons from New York in that regard, they may ask, hey, are you an eligible farmer? So do you have 2/3 gross income from farming is like number 1. What did you buy on your farm? How did you use it in farming production? Tell me about your operation. So questions like that, that we've been getting in New York over the last few years, you may get those same things there, maybe you won't, but at least you can begin to think proactively about getting your ducks in a row, maybe having those invoices nice and tidy in your file, know what you do, know what you have there. So when you do have a request for information, it's easier for you on the back end to have it all in one spot. You can submit your stuff to the audit and you can navigate the process there. The other piece that Connecticut farmers will need to begin to think about too as they manage their tax planning is, from a federal income standpoint, when you get a refundable business credit, that is going to be includable in your federal income for the next year. So in other words, there's a case, Maine's case, there's actually a couple cases there, but the premise is, as an example, if I get $100,000 back in ITC in 2026, Well, when I go to do my 2026 tax return, that $100,000 is now included in my federal gross income. And the logic behind that is simply under the tax code, income is income unless it's otherwise excluded. And because you got that money back, you've ascended to wealth. It's kind of the phrase that they use in tax court cases to say that you are better off economically by that 100 grand ITC that you got put back in your pocket from the state. As a result of you having 100 grand back in your pocket, Uncle Sam wants their share of that 100 grand because it's federal gross income. So got to keep that in mind from an income tax standpoint. That'll be a 2027 thing for farmers to be aware of. But as they think about the tax credit, how it works, what they can learn from their sister states here in New York, that's how that'll kind of work all the way through from buying the equipment to getting the credit to ultimately reporting that income on their federal returns for 2027 for any ITC in 26. And then that'll continue on, right, as it rolls on, 27 ITC, 28, so on and so forth. Another, I would say, lesson learned or just important, farm management consideration is, particularly in Connecticut, this is going to be kind of new for folks in the sense of some farms may be coming into a decent amount of cash back for their partners that they haven't had before, and so that's great, obviously, but where it can become a little bit frictionful is if you have 3 or 4 partners, 5 partners, family members, maybe looking to do a big expansion. I think it's good consultative practice to get clarity from the farm members up front. If you're going to engage in a big expansion project and get this ITC back, do we agree that we should put that money back into the business to help pay off that big expansion loan? Are we going to keep the money? Is one going to keep the money and 3 others are going to put it back in? Just having discussions around what the farm operation looks like. You bring in these multi-member partnerships that are engaging in projects. Having discussions around that, I believe, is a best practice because you want to make sure everybody's aligned on the same page as to what is our strategy around the ITC refunds. Do we get to keep them and then we get to build off farm income from that? Does that mean we take less draws now than we used to take? Or because we're borrowing money to go on a big CapEx project expansion, do we need to put that money back into the business because we have to pay off some of that debt that we've taken on to expand our farm? So all things that I believe should be discussed prior to those refunds hitting people's checkbooks, hitting the farm's checkbooks, of having a strategy for you and your business about what to do and how to deploy those refunds. Just to tie in here, the one big beautiful bill, as they call it, they've expanded a lot of the expense and provisions. So in other words, we can write off a lot of CapEx now with Section 179, right, $2.5 million of stuff. We can use bonus depreciation to write off 100% of our barns if we want to. So the only point to this slide that you're looking at is farmers have a lot of tools now going into, well, 25 and 26 now connect with the ITC. Optionality is there to really think about the best path forward for the farm. We have a lot of tools to expense buildings, machinery. Doesn't mean that you should expense it all or shouldn't. For example, if you finance a building, you may not want to write off the whole thing in year 1 because you got to pay back that principal in subsequent years. But now in 26, you also get the ITC on those CapEx items as well for machinery, equipment, buildings. So the point here is to tax plan early, often. I would start that now. If I was a farmer in Connecticut and I haven't begun to tax plan yet, I would call up your person today. You can call, if you don't have a tax plan or you've never tax plan before, I would call up somebody at one of the farm credit offices here in Connecticut. With the experience in New York State that we have on this issue, we will be certain that you will optimize this credit to the fullest that you can. So with that, Chris, I know there was a fair amount in there, and a lot that maybe people have on their minds. I know we have you're doing really good on time there. So what I'd like to do now is just kind of take any and all questions from either anybody on the panel, any farmers out there on the line, and just walk through any questions and all questions that people have to try to bring clarity and understanding to how the tax credit is going to function.
Yeah, so we have a few questions. I'll take one here that's about the eligibility as a full-time farmer. So a really common scenario is a couple that has a farm, and often one of the partners will work on the farm, and the other spouse will have an off-farm W-2 job. And so if they're married filing jointly, would that be an issue if the spouse is earning about the same as what the farmer is earning? If the spouse's W-2 job is, you following me there?
Yeah, that's a great question, Chris. And the short answer is yes. So in your example, if you think about a husband and wife who are married filing jointly, in order to determine that farmer's eligibility, like in New York, there's a 2/3 income test that we talked about, minus 30 grand of cushion for that spouse's W-2. So depending on how the math shakes out there, there could be a challenge with that farmer qualifying. But not all is lost in that case. Perhaps, again, I know we're still waiting for some guidance here from Connecticut on some of the things, because other than the statutes that have been in Bill 1487 and the budget, I haven't yet seen any instructions at this point from Connecticut or anything that they flushed out on their websites that have fully brought light to how they're looking at some of these things. But as I view the legislation, for example, if that were an issue, Chris, I believe there are planning opportunities in order to address that. For example, that farmer may want to, again, spend some more time and money in planning with a consultant, a farm consultant, to perhaps have that farm become a multi-member entity so that they can begin to separate away from their spouse's W-2 if that's causing issues. So my point there is that there are planning considerations that could be done, probably in that case where you got a full-time farmer, but their spouse is doing an off-farm thing, and at a holistic level, they're just kind of, maybe their spouse is a really world-renowned surgeon, so they're making millions of bucks, and that farm's $1 million of income is not getting them where they got to get to. They should talk to somebody, because they can probably structure around that. But that would be, on its face, a problem, as they married filing jointly on one return, aggregating all the income is not going to get you to that 2/3 gross farming income test. Yeah, great question from the member there.
Okay, and another question is, and I'll use myself as an example here because I was a farmer customer before I became an employee. So my family's business was organized as a sub S corp, and I was a W-2 employee of the S corp when I was a farmer. Would my W-2 income from that farming S corp be considered farming income?
Great question. No, but in your example, the way I understand the statute is written is that the S corp itself is what is the determinable farmer in that case. So as long as the S corp is an eligible farmer that has 2/3 of its gross income coming from farming, then the members of that S corp, even if they have a wage, they will get a K-1 from the S corp that will give them their share of the credit that they can claim on their tax return. So I believe that the qualifying place in the line is the S corp itself, Chris, in your example, not the individual member. The individual members will get their pro rata share from the qualifying entity and report that on their individual tax returns. And that'll be the same if it were a partnership 1065 LLC, for example. It would work the same way, where as long as the entity qualifies, then the members will get their share regardless of whether their income is on their personal returns, and qualify there at that level for putting it on the return and getting the refund back from the state of Connecticut.
Okay. Question about eligible investments. Clearly, equipment would be eligible. What about buildings?
Yes, buildings are too. The way it reads is that machinery and equipment, right, that are acquired by purchase, and buildings and structural components of buildings that are acquired, constructed, reconstructed, or erected on or after January 1st, 2026. So machinery, equipment, buildings, and structural components of buildings.
But
So
a
think,
real estate, oh, sorry, but a
Go
real
ahead.
estate purchase would not be considered an eligible investment.
correct. Buying bare land would not be considered an eligible investment. And even actually, you bring up a good train of thought here, Chris. As I think about New York State, for example, the way it's worded here, I would, it appears in my opinion that, for example, buying a purchased cow would not qualify for ITC in Connecticut because it's machinery, equipment, and buildings and structural components of buildings. Whereas like in New York, the way they phrase it as buying tangible personal property. So again, Connecticut will probably have to get something out there on that, but I believe based on the way it's written, if I were to buy a purchased cow, a cow is an animal, obviously, as we know on this call, but it's not machinery, equipment, buildings, or structural components of buildings. So getting into that nitty gritty is important. Even, for example, buying an F-150 pickup truck in New York wouldn't qualify. I assume based on the same criteria, buying pickup trucks are not going to qualify in Connecticut either. So as this gets unfolded here by the state with their instructions, their guides, I would bet $1 to donuts that both of those things would be true. That's how I read it as of today. So I would say, right, pickup trucks are out, buying a cow is out, buying land, that's clearly out because it's not in the statute as farm investment property. I would say, again, if it mirrors New York, employee housing shouldn't count either, probably, as this gets interpreted, right? Because you don't use employee housing in the production of stuff. It just houses people. A few years ago back in New York, the Farm Bureau tried to get that changed as part of the tweak there. It didn't end up going anywhere, but that was an issue that brought up over the years to try to make them qualify. But I would assume in Connecticut, again, unless they interpret it differently, that tenant housing would not qualify from a farm investment property standpoint. Yeah, great question around. Devil's in the details on, right? Don't assume anything and everything qualifies for investment property. It's got to be as written in the statute of the law.
Okay. Question, maybe you could speak to, the question came up from a viewer here about how Farm Credit's internal training process. In other words, will our service delivery tax professionals be fully versed in this ITC credit in Connecticut and elsewhere for that matter?
Yeah, I would say the unique part about Farm Credit East, for those the customers that work with us in Connecticut, and for those that don't, who may be thinking or looking for somebody, is again we have decades of training on this on New York State, and it's pretty much 99% the exact same credit and analysis. So we have very robust training that we do on ITC. We've done for years here in New York State. And we've begun to incorporate that training for Connecticut for our staff as well. And so if you're a Farm Credit East customer in this space, we have decades of experience in this credit. We've helped write the law in New York on some tweaks on various provisions. We helped Connecticut write the legislation on this piece with Farm Bureau and others. And so that is not a concern at all.
Okay. Paul, you had a question.
Yeah, thank you, Chris. Dario, I had a question from one of our members out in Litchfield County, and it would make sense if they have been talking to farmers across the border in New York on this one. The question was, you already mentioned about livestock. A cow is not going to qualify. The question specifically was like, for a beef herd, a brood cow that you're going to have on your farm, it's like theoretically for more than 5 years. Is that the question they asked? And I didn't know the answer at the time was, but it sounds like that will not qualify either.
Yeah, great question, Paul. As I read this, and that's where, as I was, I wrote an article a few months back on this topic for a tax return. And, as I compared it, Connecticut to New York, and they define it as buying tangible personal property, it's kind of more encompassing. But unless Connecticut comes out and just says, we're going to allow livestock to be considered machinery, I don't see how you get there, frankly, in the way the statute's written, unless they go back and allow for cows. But I would believe a purchased cow for a dairy is not going to qualify. Typically, your breeding stock's not going to qualify anyways for that type of stuff. But your raised milking cow, or your purchase of cap, I don't see how you can get there from the way they define farm investment property in the legislative language here.
Okay,
Yeah,
thank you.
great question.
Well, maybe it's a topic for another day, but we could, are there provisions in the New York law that we kind of did not include in Connecticut, and we could work at that, as on the advocacy front in the future to try to even the playing field there for Connecticut and New York farmers?
Yeah, absolutely. And I can tell you, Paul, from my experience here in New York and for Connecticut farmers on the line, as these things roll out, they're great. And even at every session afterwards, there may be kind of a slight tweak to say, okay, we forgot X, Y, or Z. It tends to be theoretically a non-issue of, okay, let's throw in livestock, raised cows for dairies or things like that. That's come up over the years on, kind of retroactive fixes in some cases there. But I think that's a great point. Another spot where Farm Bureau can do a lot of good for its members, right, in this space.
All right, well, we'll have that conversation then. Thank you.
Okay, we got a few more questions that have come in. Regarding building and structures, you mentioned that it needs to be related to production. Dario, was that a valid thing? So what about like
agricultural production? So for example, you think about a general purpose barn. If you're putting up a barn, right, that should qualify. You put up a milking parlor, you put up a greenhouse. Typically, any farm building is going to qualify. Now, on the other end, if you put up a retail building, I would say that would not qualify, right? You put up an office building on your farm, not going to qualify. You put up a retail space where you have a cash register in there and you're selling candy bars and some goods, right? So the assets got to be used in the production phase. Again, I expect there'll be more that comes out on there, but use of production would be things that are used on your farm, right? Barns, buildings that store stuff, parlors, greenhouses, single-purpose livestock buildings, that type of thing, Chris, is going to be, what's going to qualify for those buildings that are out there on the farm. Okay.
what about like fencing and say a water well for livestock?
Yeah, I would say that those, that's a great question there. Your machinery and equipment, again, going back to those things are certainly capital assets. They're improvements on the farm. That may need a little bit of extrapolation from Connecticut too. Is fencing considered machinery and equipment? In that regard, is tiling, drainage? In the IRS world, those are 15-year assets. They're improvements. Are they going to be allowed, disallowed? And some of this may flush out over time too, where Connecticut may not give guidance so far, and may not know. But yeah, great. That's a great question, Chris. About how do they define some of those 15-year improvements, for example? With tile, like a perfect example, like something that qualifies in New York. Tiling in New York qualifies, right? You put it in the land. It helps with your production of the land. It's a capital asset, but that's a 15-year IRS asset. But it's personal property that's used on the farm in New York. But is that machinery equipment in Connecticut? That's where, again, I think there's a little more that's got to get flushed out there.
Question came up regarding garden centers. A common scenario with a lot of garden centers is they may grow a portion of their product throughput, but also have a lot of resold plants or other garden related items. Would their total gross be considered the farm income, or would it only be their own agricultural throughput?
Yeah, great question there of how much of, there's a couple components to that, Chris, on that too, is the throughput going to be considered or not? And then you have the other issue there is you have cost of goods sold that could impact how much is there too. Great question. I don't have 100%. I don't know 100% the answer to how it'll flush out for how Connecticut looks like that. If they're like in New York, what New York has done is they have flushed out kind of worksheets to kind of go through, depending on your entity structure, what lines they are looking at there. But yeah, the gross farm income, if you have a lot of like non stuff that you're growing, that may not very well be considered farm income, right? So in that case, then thinking about planning of how much are you growing and producing versus how much you are buying in, that's again where I think getting proactive now for people that are in that bucket, they should be talking to their advisors now to think about and go through those questions and how to best, if there's any issues, structure their operations to optimize these things for 26, because there is still time right now to work with people on a consultative level to really map out what your entity org structure looks like in that regard. You know, even for the example of, right, a lot, like in New York, for example, a lot of entities have a separate entity for where they grow the grapes versus the actual winery for similar purposes over the years. But you may need two entities if you have, right, grapes that you're growing and then retail wine establishment there. So thinking about things like that, how you structure them, how you do all that stuff. Apple packing houses versus growing apples, right? Different packing revenue is not farm revenue. So, you know, folks in New York over the years, right? We got packing LLCs, we got growing apple LLCs. There's a lot of nuance behind the right structure here. Because remember, at the end of the day, whether they're tax credits or tax deductions, you know, in the tax cases over the years, you know, federal and state, they are all things that are considered legislative grace. So in other words, it's your obligation as a taxpayer to fully conform with how the law is written, because even if it's close enough, it's not good enough from a compliance standpoint, and you may be leaving money on the table. So that's why I can't emphasize enough. Now is the time to be thinking about all of these entities, all this planning. Do you have the right structure? And really go through understanding without assuming that you're going to qualify, making sure you know what your entity structure is, how it works, and set yourself up going into January 1st with the best possible place to succeed as far as taking full advantage of this new Connecticut ITC. Yeah, great question, Chris.
Another question came out that it sounds like there's a fair amount of this that needs to be sort of determined by the Connecticut Department of Revenue's practice or case law, or how things are going to be interpreted as far as like what specifically might be eligible or what or might not be. Do you think that's the case, like that over the next year we're going to see a little more clarity on some things?
Perhaps. I would say yes and no. You know, on the statute as written, right? We have pretty good ideas of, right? We have to be an eligible farmer. We know you can only you have to buy machinery, equipment, right? Buildings or components that are used in production. So, right, you know, we know like 95%, like I mentioned earlier, of all those things that are in there. It's gonna be those things in the fringes that are like, how do they interpret them? Like, for example, I mentioned that tenant housing. And going off of New York in my analogy here, I'm 99% sure that that's not going to qualify. But has Connecticut said that? The answer is no, right? They haven't said that. I'm using, right, 15 years of experience on that same issue that we've learned in New York on that topic. But it could take some time. Again, there may be things that don't get put out there. It may develop over the course of some people trying to take it and being denied, right, out there in Connecticut somewhere. But on the other hand, they may put out facts and questions on this, on how they're looking at different things. Time will tell. At the very least, there should be instructions as to the credit form and how the credit instructions work. But typically, the credit instructions tend to kind of just mirror what's written already in the statute. So there may not be additional information on that. But yeah, I feel pretty confident with 95% of the farms and what they're going to buy, what the answer is. It's those things that are on the edges of, well, and that goes into a little bit of the farmer themselves too. Is like, as advisors, well, this thing, you know, does tiling count? Well, I don't think so. It could. Can we make a case? You know, if we make a case, you know, do we have a reasonable basis, as they call it in the tax law, to make a case? Or if we make a case without having any good facts, are we going to have penalties and interest on our position if we get overturned? All things that need to be thought through with our advisors now. But yeah, I think that I would say partially true on that premise there. I think with 95% certainty, we know most of it, but there are probably a few things on the edge that are, you know, may need some further clarity on a few things there. Like I'll give you an example, another one here that I think is interesting, right? An eligible farmer in Connecticut, they're defined as having 2/3 of your gross income from farming, for example, right? You know, that's what we talked about. The sale of wine is typically on a Schedule C. So wine income is not farm income. right? From a federal tax standpoint, it's not farm income. But then you go into farm investment property, and it allows you to buy things that are used in agricultural production, which includes stuff that you would buy to, as part of the winery there, because the Farm Bill 1497, included wine, Christmas trees, apple cider things that are in the what's used in agricultural production. But that may get into, for example, was it the intent of the legislator to say, okay, you may be having all this farm income, and as long as your production stuff is still only a third of your farm income, you're okay. If it gets more than that, you may be not okay. And that may require then bifurcating out or splitting up, get winery versus the grapes, the apple cider versus the growing of the apples. And so I think it's things around those edges that where does, the production versus the manufacturing begin phase. Certainly guidance would be welcome, but how much we're going to get at this point, no, I cannot answer that.
Another question that came in, some good questions coming in, by the way. Another question that came in is what about delivery trucks, assuming you're delivering your own farm products on them?
Yeah, I would say delivery trucks, no, right? The machinery, equipment, my take was like New York, delivery trucks would be a no, would be how I would answer that question there. Machinery, equipment, buildings, and structural components, I would say no delivery trucks.
What about solar panels on the roof of your barn?
Solar pan, that's an interesting one because, again, as I use my 50 years of New York State experience, in New York's experience, they specifically disallowed in their statute property used for electricity. So Connecticut statute is not like that. But the question then, the analysis, if you will, if we're going to make sausage here together is, do we want to, or can we make the argument that that solar panel is used in the production of farming? Is that solar panel helping to provide energy to aid crops? So as I look at this from a nerdy tax standpoint, there might be a decent case because it's not specifically excluded like it is in New York, because New York banned explicitly property used to generate electricity. This statute does not have that. So could there be a case for solar panels that are used in the production process? Could very well be, Chris. Again, back to your prior comment there that somebody made, maybe a place where guidance would be welcome there, but there could be a case there if that equipment is used for right somewhere in the production process, perhaps.
Okay. Yeah, so I'm just mulling over this solar thing. So no digesters either on like a dairy.
Well, I actually think digesters. I believe digesters are farm equipment. I would say so. Again, compared to New York, an ag digester is in my opinion, it's a piece of farm equipment. I would say that there is a strong case to be made that should qualify for ITC in my opinion.
Okay.
And we've had success on those in New York State going through that process there. But an ag digester is a key component of farm production. Right? You need to regulate manure, right? If you're a dairy farm, and so that's a critical component of running a dairy operation at a certain size and scale.
And of course, for some of this renewable energy, there's other credits and incentives that come into play as well, beyond just the ITC.
Yeah, and that's a great point there, right? There's obviously with solar and or digesters, there's a lot of federal credits, although that's sort of been a hot potato, as you know, Chris and others know on this call, where those are kind of, they're out there, but there's some of them are coming to an end sooner than later. And depending on how you get the credit there, it does have impacts on what your possible ITC is for the state, because there's gyrations on the calculations of how you have to reduce your tax basis of what you bought an asset for, depending on if you get a federal credit. So federal credit may reduce the base of what you get your state credit on in those cases. But yes, with digesters and solar, there was a bunch of green energy credits that go into farmers that are engaging in those efforts right now, whether it's solar or digesters, to get federal credits as well.
So just to play out, like say a greenhouse example here, if I want to play it safe and stick to things that I know are going to be eligible, I would think things like expanding the greenhouse itself, improving it, furnaces, like climate control, automation in the greenhouse that's used for production, tractor maybe, but not going as far as delivery trucks or that sort of thing, but stick to the greenhouse production.
The stuff that the greenhouse and the greenhouse that makes it run, like the things that are helping the greenhouse keep those those plants safe. Yeah, I think that's right. All that machinery that's in the greenhouse right? That's 100% involved in production in my opinion.
Okay. Okay, and again, I think there's some things yet to be determined there as we are saying. Any questions from Tracy or Paul?
No, I mean, I think you guys have been pretty comprehensive, and these questions have been really helpful to gain some little additional clarity. But I can see that, you know, there does appear to be the need for a little further clarification, and we'll have to wait, you know, see what DRS comes out with as far as the specific guidelines, and then maybe we can use that in comparison with what New York farmers have, and see what we need to pursue in the future.
Yeah, and I will add that should further information become available and the need is there to do further clarification on this, we can have a follow-up webinar, you know, sometime in 2026 or you know, whatever's called for. So
yeah, and certainly you know, we will as well. Anything that we learn, if anybody on the call is not on our blogs, you know, we are pretty timely with our tax talks blogs. So as things come out from that are related to farming across the Northeast here, we will put out timely information on anything that we learn from a statutorily update standpoint. So keep abreast of those. If for those of you that don't follow our blog, there's some very good information that we put out there as we learn more in real time. And you know, we're here as a resource for our customers for Northeast agriculture, and in this case, Connecticut specifically.
okay, to wrap up, I'd like to mention that all of our webinars, past, present, and future, including the recording of this one, will be archived at farmcrediteast.com/webinars. We do have a exciting webinar series coming up this fall and winter. We're going to be doing industry outlooks on all our major loan sectors, including things like green industry, dairy, row crops, winery, fishing. We're going to be doing a lot of different industry sectors that we'll cover, as well as some general topics that apply to all of agriculture. So stay tuned for that. There will be more webinars and educational information to come. And with that, would you like to make any final wrap-up comments, Paul?
Hey, no, I just think you guys have done a great job today. This is really the first introduction for many of us in the state to learn how this is actually going to work. So I realize there's some more information might need to be put out there as we wait for DRS to come out with their paperwork and how it's all going to actually apply to our operations. But this was a great first start to help our members and help farmers in Connecticut understand, you know, how we can take advantage of this program. So thank you very much.
Wonderful. And I'll just put in a final plug for Connecticut Farm Bureau membership. I'm a member. It is worth being a member to support their efforts to advocate for policies that are favorable to agriculture. Sometimes that means an affirmative policy action like passing an investment tax credit. Sometimes it's a defensive position to advocate against a policy that might be harmful to agriculture. Perhaps more often that's the case. Being a member is inexpensive and it's a worthwhile business investment. So I will put in that plug. And with that, I guess we will sign off. And thank you very much for your attention.
Thank you, Chris. Appreciate your efforts.
Thank you, Dario.
Bye-bye. Thank you.